Welcome back to the Daily Crypto Roundup. Today's episode is about context, because over the last 24 hours, the market has shifted tone again. We're no longer talking about a clean pump. We're talking about pullback, liquidation, consolidation, and decision-making. Bitcoin has slipped back toward the low $90,000. Ethereum has cooled around $3,200, and across the rest of the market we're seeing leverage unwind rather than panic selling. That distinction matters, because it tells us what kind of market we're in, and what kind of week we're likely heading into. So today, we're going to cover the prices, the liquidation event that shook the market, what whales and institutions are actually doing underneath the surface, the regulatory and geopolitical pressure that's weighing on risk assets, and finally, the key things to watch over the coming days. This isn't about calling tops or bottoms. It's about understanding why price is behaving the way it is right now. And before we get into it, quick reminder. We're still running the XRP giveaway, so if you've got thoughts on the market or today's episode, drop a comment and you'll be in the mix. Let's start with the market itself. Bitcoin is currently trading in the low $90,000 range, having slipped below $93,000 earlier following a sharp liquidation event. Ethereum is sitting around $3,200, down from recent highs, but still holding above major structural support. XRP is hovering close to $2. Solana has pulled back to $134. Binance Coin is just under $930. Cardano is sitting below 37 cents. And Dogecoin is holding around 13 cents. Now, it's important to address something that's been doing the rounds today, because a lot of people are pointing to Trump's tariff comments as the reason for this pullback. And that's only part of the story. Yes, the renewed tariff rhetoric absolutely acted as a short-term trigger. It pushed global markets briefly into risk-off mode, strengthened the dollar, and crypto reacted quickly, as it usually does. But it's important to be clear. The tariffs didn't create the conditions for this move. They exposed them. Bitcoin was already trading near resistance. Leverage had quietly built up underneath the move, and long positioning was crowded. When the tariff headlines hit, price slipped just enough to trigger liquidations, and once that started, the move accelerated mechanically. That's very different from a fear-driven sell-off. We didn't see mass spot selling. We didn't see long-term holders rushing to exits, and we didn't see a structural breakdown. What we saw was a leverage flush sparked by a headline, not a fundamental shift in conviction. The market saw roughly $600 to $700 million in long liquidations in a short window as Bitcoin dipped under key intraday support. That tells us two things immediately. First, the push toward the mid to high 90s earlier was partly leverage-driven, not purely spot demand. Second, once that leverage unwound, price fell quickly. Not because everyone suddenly became bearish, but because forced selling took over. That distinction matters. In bear markets, sell-offs are driven by fear and lack of buyers. In liquidation events, sell-offs are driven by mechanics, not conviction. And once the forced selling is done, the market often stabilizes. Now, zooming out slightly, this pullback fits a broader pattern we've been talking about: consolidation after a strong move, not collapse. Bitcoin had rallied sharply earlier in the month, helped by institutional inflows, ETF demand, and renewed macro optimism. When markets move that fast, they tend to build fragile leverage structures underneath. Those structures eventually get shaken out. That's exactly what happened here. Now let's talk about institutional and whale behavior, because this is where the story gets more interesting. Despite the pullback, large holders have not been dumping aggressively. Exchange balances for Bitcoin and Ethereum remain relatively low compared to last year, suggesting coins are still being held rather than rushed onto exchanges to sell. On-chain data shows that long-term holders are largely sitting tight. That's important, because in true market breakdowns, long-term holders tend to capitulate alongside short-term traders. We're not seeing that. We also have to acknowledge one of the biggest signals in the market right now: corporate and institutional accumulation. Earlier this month, MicroStrategy, now branding itself simply as Strategy, disclosed another massive Bitcoin purchase, adding over 13,000 BTC for roughly $1.25 billion. That's not a short-term trade. That's a balance sheet level decision. the company now controls a meaningful percentage of the total Bitcoin supply, and its strategy remains unchanged, and that's to accumulate through volatility. Even more quietly significant was the disclosure that a U.S. state pension fund, the Louisiana State Employees Retirement System, has taken exposure to Bitcoin indirectly via MicroStrategy shares. The amount is small in absolute terms, but the signal is large. Pension funds don't chase momentum. They move slowly, cautiously, and with long-time horizons. That kind of participation doesn't show up at market tops. It shows up during transition phases, when institutions are building exposure over time. At the same time, digital asset investment funds have seen billions of dollars in inflows over the past couple of weeks. Even during the recent pullback, there hasn't been a mass exodus from these products. That suggests institutional investors are treating dips as opportunities, not exit points. Now, let's talk about macro and geopolitics, because this is where the pressure is coming from. Over the last 24 hours, markets globally have shifted into a more cautious stance following renewed trade tension rhetoric and uncertainty around tariffs. Comments around potential US-EU trade disputes, combined with broader geopolitical noise, have pushed investors toward a risk-off posture. When that happens, high-beta assets like crypto tend to feel it first. On top of that, markets are looking ahead to central bank events, particularly the upcoming Federal Reserve meeting. While inflation has cooled compared to last year, it's not yet at a level that gives policymakers complete comfort. That leaves traders in limbo, unsure whether rate cuts will come sooner or later. When expectations are uncertain, markets tend to de-risk. This is why crypto right now is trading less on internal narratives and more on macro sensitivity. Bitcoin, in particular, has increasingly behaved like a global liquidity asset. When the dollar strengthens or yields rise, Bitcoin tends to soften. When liquidity expectations improve, Bitcoin catches a bid. That doesn't mean crypto has lost its unique drivers, but it does mean you can't ignore macro anymore. Now let's look at regulation, because this is another slow-moving but important factor. In the US, lawmakers are pushing ahead with crypto market structure legislation, but it's not smooth. The Senate Agriculture Committee is preparing to mark up a bill that would expand the role of the CFTC in overseeing digital commodities, while the Senate Banking Committee continues to wrestle with the Clarity Act. The big sticking point remains stablecoins, specifically whether non-bank entities should be allowed to offer yield or interest on stablecoin holdings. Coinbase has made it clear that it sees restrictive language here as a threat to innovation and competition. Lawmakers, on the other hand, are under pressure from traditional banking interests. This regulatory tug-of-war hasn't caused today's sell-off, but it contributes to uncertainty, and uncertainty keeps risk appetite in check. Outside the US, regulation is moving faster and more decisively. The European Union has begun enforcing new crypto tax reporting rules, requiring exchanges and service providers to report user transactions directly to tax authorities. This is part of a broader push toward transparency and compliance. While it may discourage some speculative activity, it also signals that crypto is being fully integrated into the financial system, rather than treated as a fringe experiment. In Asia, we're seeing mixed signals. South Korea has lifted a long-standing ban on corporate crypto investment, allowing public companies and professional investors to allocate a portion of capital to digital assets. That's a major shift from one of the world's most active retail crypto markets. At the same time, China continues to enforce strict controls, while other countries like Kazakhstan and parts of the Middle East quietly expand crypto usage. Now let's talk about altcoins, because this is where differentiation really shows. During the recent pullback, altcoins have generally underperformed Bitcoin and Ethereum. That's normal. In periods of uncertainty, capital tends to retreat toward the most liquid, most established assets. What's notable is that we're not seeing indiscriminate dumping across all coins. Instead, we're seeing selective weakness and selective strength. Some gaming and ecosystem tokens saw sharp moves earlier in the week and are now giving some of that back. Other large-cap altcoins like Ethereum and Solana are consolidating rather than collapsing. That suggests the market is rotating and rebalancing, not panicking. XRP is an interesting case. Despite broader market weakness, on-chain data shows continued accumulation by large holders around the $2 level. That doesn't guarantee upside, but it does suggest confidence among participants with long-time horizons. Now, looking ahead, there are several concrete risks and catalysts over the coming days. First, token unlocks. January is a heavy month for unlocks, with over $1 billion worth of tokens scheduled to be released. Some of these unlocks have already caused short-term price drops, as early investors take profits. This doesn't necessarily change long-term fundamentals, but it does increase volatility. Second, macro data. Jobless claims, inflation readings, and Fed communication will all influence risk sentiment. Crypto will react quickly, sometimes disproportionately, to surprises here. Third, liquidity conditions. With US markets closed today due to a holiday, crypto trading can become more erratic. Thin liquidity exaggerates moves, both up and down. Fourth, technical levels. For Bitcoin, the low $90,000 is now the key support zone. Holding above it keeps the broader uptrend intact. Losing it decisively would suggest a deeper consolidation or retracement is needed. For Ethereum, the $3,100 to $3,200 area is critical. As long as that holds, Ethereum remains structurally sound. So where does that leave us? Right now, the crypto market is in a transitional phase. The easy upside from the early month rally has paused. Leverage has been flushed, sentiment has cooled. But the longer-term structure, institutional participation, long-term holder behavior, regulatory progress, and global adoption remains intact. This is not the environment where you expect straight-line moves. It's an environment where patience, positioning, and discipline matter. The worst thing traders can do here is overreact, either by chasing every bounce or panicking on every dip. The smarter approach is to watch how the market behaves under stress. Does it stabilize? Do buyers step in? Do key levels hold? So far, we're seeing absorption, not fracture. That doesn't guarantee higher prices tomorrow. But it does suggest the market is still deciding, not breaking. As always, stay informed, manage risk, and don't let short-term noise override long-term thinking. Drop your thoughts in the comments, make sure you're in for the XRP giveaway, and let us know what you're watching as this week unfolds. Thanks for listening. And as always, we'll see you at the top.